These talks are brought to you by Claritax Books and are proudly sponsored by 6 Forward Capital Allowances.
Welcome back to our series of talks on capital allowances. This week we're taking a look at the topic of special rate expenditure. Before we start, however, I'll just mention that the 2015-16 editions of my 2 capital allowances books, that's Capital Allowances and the A to Z of Plant and Machinery, have now been published and are available from Claritax Books. All of these talks are based on the content of those books, which are co-authored by Mazar partner Lindsay Pentelow. The special rate expenditure rules operate to slow down the rate at which tax relief is given for certain classes of asset. The concept of special rate expenditure was introduced from April 2008, since when the categories affected have gradually been expanded. To achieve the slower rate of tax relief, certain types of expenditure are allocated to a special rate pool, attracting plant and machinery allowances at a slower rate than other assets. The most commonly found classes of special rate expenditure are for integral features, such as general electrical systems in offices or other buildings, and higher emission cars. Other categories are for thermal insulation costs, long-life assets, so-called cushion gas, and, since 2012, solar panels. It's possible that part of the capital expenditure on particular assets will be special rate expenditure and part will not. In that case, the 2 parts are treated as expenditure on separate items of plant and machinery, using a just and reasonable apportionment to allocate the expenditure between the 2 notional assets. The rate of writing down allowances for the special rate pool is 8%. As for the main pool, the maximum allowance is proportionately reduced if the chargeable period is less than a year, or if the qualifying activity is carried on for only part of the chargeable period. If the period is more than a year, which is only possible for income tax purposes, the maximum allowance is increased pro rata. The special rate pool is subject to the small pools rule, whereby expenditure may be written off in one go once it falls below a given threshold. The small pools rule operates where, in the year, the value of the pool does not exceed £1,000. That value is calculated by adding the amount brought forward to any additional expenditure in the year, and then deducting any disposal proceeds. If the result does not exceed £1,000, then the whole amount may be written off in one go. Although writing down allowances are given at a slower rate for special rate expenditure, annual investment allowances are available for most such expenditure, subject to normal principles. Indeed, AIAs should always be claimed first against any special rate expenditure to ensure the best overall rate of tax relief. Where special rate assets are likely to be scrapped within a few years, it may be beneficial for a sole trader or a partnership to ensure that there is an element of private use. This will mean that the tax relief catches up with the depreciation suffered over the period for which the asset is owned. This was illustrated in Talk 26. There are a few anti-avoidance rules to watch out for in relation to special rate expenditure, but these will rarely catch genuine commercial transactions. One such rule applies to disposal values, but it only operates where a disposal is part of a scheme or arrangement designed to obtain a tax advantage in relation to plant and machinery allowances. Further anti-avoidance measures apply where a company has incurred expenditure on special rate cars and where the company's qualifying activity is then permanently discontinued. For the next 2 weeks, we're going to focus on capital allowances for cars, picking up a few quirks that are worth watching out for. Thank you for watching. I'm Ray Chidell, author of Capital Allowances and of the A to Z of Plant and Machinery from Claritax Books. This talk was sponsored by 6 Forward, an independent property tax consultancy working with accountants to enhance capital allowances for their clients.